the steps in accounting cycle? The first step in accounting cycle is analyzation of a business transaction or determining whether a transaction is a business transaction or not. So, how are we going to determine if it is a business transaction? It is a business transaction if it affects the elements of the financial statements. So again, we can determine if it is a business transaction if it affects the elements of financial statement. And what are these elements of financial statements? We have the assets, the liabilities, equity or capital, revenue, and expenses. These 6 are the elements of financial statements, or rather 5. Okay, examples of assets. We have cash, we have accounts receivable, we have office equipment, we have office furniture and fixtures, we have prepaid rent, prepaid insurance, land, building. So those are examples of assets. Then we have examples of liabilities. We have accounts payable, we have salaries payable, we have rent payable. And examples of expenses, we have salaries expense, rent expense, interest expense, and office supplies expense. So after analyzing and identifying the elements of the financial statement, the next is we have to determine how these elements were affected. Were they increase or decrease? So, in accounting, to increase or to decrease is either debit or credit. But not all debit is plus or increase and not all credits is minus or decrease. Okay, so what are those accounts or elements that were the increase is debit and decrease is credit? So we have debit balance account. Or these accounts means if we're going to debit, it means we're going to increase plus. And if we're going to credit, it means we're going to deduct or minus. And what are these elements? We have assets, we have expenses, and let us include withdrawal. Withdrawal, though it is not an element, it is a contra capital account. So it is treated the same as an asset. So for these 3 elements, assets, expenses, and withdrawal, it means if we're going to increase the assets, expenses, and withdrawal, we have to debit. And if we're going to decrease, we have to credit. But it is on the asset that were affected both by debit, which is plus, or credit, which is minus. Because expense and withdrawal were only affected by increasing it. So, ibig sabihin, or it means, expense will always be on the debit side. It is always plus, so it is debit. While the other 3, credit balance account, we have the credit balance account, which means if we're going to increase, we have to credit. And if we're going to decrease, we have to debit. And what are these accounts or elements? We have liabilities. We have revenue, equity, or capital. And we have revenue. Also, with these 3 elements, liabilities, equity, and revenue, it is only liabilities that were affected, either increase or decrease. So that is credit plus or debit minus. Because the other 2, equity and revenue were always affected by increasing it. So it is always credit. Okay. So let us review it again. For assets, expenses, and withdrawal, to it is to increase is debit and to decrease is credit. But it is only assets that were affected both either by increasing or decreasing. So it is only asset that are going to have debit or credit, because expense and withdrawal will always be debit or increase. On the other side, credit balance account, that is to increase is credit and to decrease is debit. Those are liabilities, equity or capital, and revenue. And again, for these three accounts, it is only the liabilities that will be affected either by credit or debit, by increasing or decreasing, because equity and revenue will always be affected by increasing it. So it is credit. Okay? Let us have some examples. So this will serve as our guide. Okay. So let us have our example problem. On May 1, 2020, Aleph Mateo opened Aleph Mateo Delivery Services. The entity completed the following transactions in May 2020. May 2, transferred from personal bank account 100,000 to the company's checking account to start his business. So first is, let us apply the plus minus or increase decrease. Let us identify first what are the accounts that were affected. Okay, but before that, let us, for the requirement, journalize the above transaction using the following accounts. So these are the elements, the specific elements of the company, of the entity. So let us identify first what particular elements are this. Okay, cash. Of course, cash is an asset. Accounts receivable is also an asset. Prepaid insurance is also an asset. Service vehicle is an asset. Office equipment is an asset. Accounts payable is liability. Aleph capital is equity. Aleph withdrawal is a contra account against equity, which is treated the same as an asset. We have delivery revenues, that is revenue. Salaries expense, that is expense. Gas and oil expense. Repairs expense. Advertising expense. Supplies expense. And miscellaneous expense. All of those are expense account. Okay, so again, let us start with our May 1 transaction. Again, transferred from personal bank account 100,000 to the company's checking account to start his business. So we have here 100,000. So first, what are the accounts that were affected? We have 100,000, so that is cash. And Aleph Mateo just started his business. So it is an investment. So for investment, that means that is Aleph Capital. So what are the accounts that were affected? May 1. So we have May 1. We have cash. And we have Aleph Capital. Again, for our guide, Aleph Capital is always plus. So plus Aleph Capital. And what happened to the cash of the entity of the business when the owner invested cash into his business? So what happened to his capital, to the capital of the business? It increases. So plus cash of 100,000. Okay, next. Place 4-weekend advertisement in the Sun Daily Central Luzon for 18,500. The amount is due in 30 days. Okay, placed 4-weekend advertisement. From that phrase, advertisement, so it means it is advertising expense. And when are we going to pay that 18,500? The amount is due in 30 days. Okay, it means that we owe the Sun Daily Central Luzon. So, that is accounts payable. So, what are the accounts that were affected? It is advertising expense and accounts payable. 18,500. That is May 3. So, we have advertising expense and accounts payable. Okay, advertising expense for our guide is always plus. So advertising expense, that is an expense, it is always plus. And we have accounts payable. What happened to our accounts payable? Does it increase or decrease? So it means it increases also because we owe the advertising company. So our accounts payable, our liabilities increase because we owe the advertising company by 18,500. Okay, next. Both supplies on account from Supplies Incorporated, 8,800. Both supplies. Okay, so from this phrase, both supplies were affected. So we have prepaid insurance, we have supplies expense. Supplies expense were affected. And on account, there is a word on account. Take note, if you read the word on account, either accounts payable or accounts receivable were affected. If it is accounts payable, it means we owe somebody. And if it is liability, and if it is accounts receivable, somebody owes us. So it means that we have to receive something, a payment from somebody, if it is accounts receivable. So in this case, since we bought supplies, it means it is an accounts payable. We owe somebody, and that is the Supplies Incorporated. Okay? So, 8,800. That is May 6. So you have, again, supplies expense, and accounts payable. Again, our guide for supplies expense, it is always plus. So our expense is plus, and accounts payable. What happened to our accounts payable when we owe? That is plus also. So it increases our accounts payable, our liability. Okay. And 15. Alat invested in the business-owned office equipment in the business-owned office equipment with a fair market value of 52,500. By the way, this one is 8,800. Then we have 15. Alat invested in the his own office equipment with a fair market value of 52,500. So what are the accounts that were affected in this transaction? We have office equipment, and it is an investment, additional investment by the owner. So if it is an additional investment, our capital again is affected. So what are the accounts affected? Capital and office equipment. Okay? So we have Alat capital and office equipment. Okay. What happened to Aleph capital? Again, capital in our guide, capital is always plus. So capital is plus. And what happened to the office equipment of the business? It also increases because before there is no office equipment, but since now the owner invested an office equipment, so there is an increase in office equipment by 52,500. Then, Received 61,800 from customers for services rendered. So what are the accounts affected? Again, we have received 61,800. From this phrase, received 61,800, it means cash were affected. So we have 17. So cash were affected. We received cash of 61,800 from where? From the customer for services that we have rendered. If we read this phrase, services rendered, it means revenue were affected because we are dealing with service industry and we earned our revenue by rendering services. That is why every time we have this service rendered, it means our revenue, delivery revenues were affected. So we have delivery revenues. Okay, cash. How is cash affected? We received cash. It means what happened to our cash? It increases. And for our delivery revenue, our guide, it is always plus. So plus delivery revenue. And received a bill, 22. By the way, that is 61,800. Okay. Received a bill from park tracking for repair services performed, 8,500. Received a bill. If this is the transaction, or in every transaction, if we have a word bill, again it is either an accounts receivable or accounts payable. If we receive a bill, it means somebody is asking us to pay them. So we owe them. But if we send a bill to a customer, we are asking that customer to pay us. So in this problem, we receive a bill. It means that somebody is asking us to pay them. It means this is liability. It is an accounts payable. If we give or if we send a bill to a customer, it means they owe us. So it means we have to receive from them. So it means it is an asset accounts receivable. So in this transaction, we receive a bill, so that is accounts payable. And why did we send us a bill? Because they render services for us. They repair our service, repair something for us. So that is an expense. So that is repairs expense. Okay, again, it is accounts payable, that is 22. That is accounts payable. And we have repairs expense. Okay, for our repairs expense, again, our guide expense is always plus. So repairs expense is plus, and accounts payable. So what happened to our accounts payable? It increases also. So accounts payable is increased because we owe somebody. Okay. Then we have paid supplies incorporated, 8,800 in full payment of account. Again, paid. There is a word paid. From the word paid, what will we use in paying? So it means if there is a word paid, cash is affected. So that is 26. May 26. So cash were affected because we pay. And what usually we use in paying our accounts, it is cash. And we have here on account. which means we pay our account, which means that is our liability. So we have accounts payable. Take note, let us just make this clear. In transaction May 26, paid supplies incorporated 8,800 in full payment of account. It is not supplies and cash who are affected. It is cash and accounts payable because the supplies will record the effect of the supplies on the previous transaction, May 6, in this one, both supplies. It is in this transaction that supplies were affected because here in 26, our transaction is we pay our account. We pay our accounts payable. That is why the accounts that were affected is cash and accounts payable. So, how is our cash affected when we pay? Of course, it decreases, so minus. And also accounts payable, what happened to our accounts payable when we pay it? Of course, it also decrease our accounts payable. Okay. Next is paid salaries to employees. Okay, again, there is a word paid, which means cash were affected, and salaries, which means that is salaries expense. So, 29. By the way, this is 8,800. So, 29. Again, cash were affected because we pays, and salaries expense. Okay, again, what happened to our cash? It is minus. And what happened to our salaries expense? It is plus because that is our guide. Okay. Then we have number 30. Receive 39,000 for services performed. Again, we have services performed. And we have received 39,000. So from this phrase, receive 39,000, it means cash were affected. We have cash and we have services performed. So that is delivery revenue. Again, as we have discussed a while ago, every time that we have this phrase services performed, it means our revenue were affected. So when we receive cash, what happened to our cash? It increases. And again, in our guide, revenue is always increase. So it is plus. Okay. Then, 31. Receive unpaid gasoline and oil bill relating to service vehicles. Receive unpaid. There is a word paid. So from this word paid, it means cash were affected. And what is the accounts that we pay? Why did we pay? Because of gasoline and oil. And gasoline and oil is an expense. That is gas and oil expense. So again, that is 31. Again, cash were affected because of this word paid and gas and oil expense. Okay, what happened to our cash when we pay? It means it decreases. And again, gas and oil expense, our guide says that it is always plus. So that is plus. By how much? Let us put the amount first. So 29, that is 21,000. And then the next one, 30, that is 39,000. And this one is 12,500. Then we have 31. Build. South China Bank for services performed, 45,000. So we have again this word build. Again, as I have said a while ago, if we have the word build, it means accounts receivable or accounts payable. So, in this transaction, we build South China Bank. What do you think it is? Is it accounts payable or accounts receivable? We build our customer. It means it is an accounts receivable. And again, we have this phrase, service rendered, service performed, which means delivery revenue were affected. So we have 31. We have accounts receivable, and we have delivery revenue. So accounts receivable, we billed our clients. So what happened to our accounts receivable? It increases. And delivery revenue, in our guide, it is always plus. Okay. And we have the last transaction. Alep withdraw cash for personal use, 14,500. So by the way, this is 45,000. So again, August 31 transaction. Alep withdraw cash for personal use. Withdraw cash. So automatically, cash were affected. So 31, cash were affected. And the owner withdraw. So withdraw, so that means that is Aleph withdrawal. So we have Aleph withdrawal. For cash, how is cash affected? What happened to the cash of the business when the owner withdraws from it? Of course, it decreases. And we have Aleph withdrawal as per our guide, that is also plus. Okay. Now, after applying the plus minus, let us now apply the debit and credit. By the way, this one is 14,500. Okay. So, let us now apply our debit and credit. Okay. So, to write our debit and credit, by the way, for every business transaction, two or more accounts were affected. It should not be only one account. It is always two or more account. It can be asset liability, liability expense, asset and capital, revenue and asset. Okay. And in recording the business transaction, that is journalization for accounting terminology, it is journalization. To journalize our transaction, we have to record first debit. So in a transaction, there should always be debit and credit. So there can be one debit and two credits, or two credits and one debit, but take note, there will never be only debit or only credit. There should always be debit and credit. Okay. So again, our guide for assets, we have debit is plus and credit is minus. But it is only assets that will have debit and credit. Expense and withdrawal is always debit. For liability, equity, and revenue, to credit is plus and to debit is minus. But it is only liabilities that there will be credit and debit. For equity and revenue, there will always be credit only. Okay. So, again, as I have said, debit is always should always be recorded first. So, for our first transaction, May 1, we have cash is the plus. So, cash is an asset. So, to increase our cash, our asset, that is debit. So, we have cash, 100,000, and Aleph capital. To increase our capital, that is credit. $100,000. To record your debit and credit, your credit should be indented, also the amount. Okay? So, again, to record your debit and credit, if you write your debit here and then your credit, it should be indented. It should not be in aligned with your debit. Okay, so that is May 1. For the next transaction, May 3, that is advertising expense is plus. Again, our guide, advertising expense. Expense is always debit. It is plus. So, that is advertising expense. And we have accounts payable plus. For accounts payable is liability. So, for liability, to increase our liability, it means credit. So, we have accounts payable. That is 18,500. Okay, next is May 6. In recording your transaction, you only have to write the month on the first transaction. The succeeding transaction is only for dates. Okay, so we have supplies expense. Again, supplies expense is an expense. Our guide is for expense, it is always plus. So it is always debit. So we have supplies expense. And we have accounts payable. Accounts payable is liability. Accounts payable is liability, and for our liability to increase is credit. So we have accounts payable. That is 8,800. Then we have 15 Aleph capital plus and office equipment plus. Aleph capital in our guide, equity or capital is plus and that is credit. So it should be credit. And we have office equipment. Office equipment is an asset. And to increase our asset, it means to debit. Okay? So we have to record first the increase of office equipment because it is debit. So debit, office equipment, and credit, Aleph capital. Again, Aleph capital is always plus. So it is always credit. That is 52,500. Then we have 17. We have cash and delivery revenue. Cash is plus. So cash is an asset. So how are we going to increase our asset? It is debit. So we have cash and we have delivery revenue. Delivery revenue is revenue. Again, in our guide, revenue is always plus and it is always credit. So we have delivery revenue. That is 61,800. Okay. Next is accounts payable plus and repairs expense plus. So accounts payable plus, in our guide, accounts payable is liability. To increase our liability, it is credit. So it should be the second one. So we have 22. And we have repairs expense. Again, in our guide, expense is always debit. It is always plus. So we have to record our expense first because it is debit. So we have repairs expense. And we have accounts payable. That is, we don't have the amount, 22. That is 8,500. Okay. Then we have May 26. For May 26, it is cash minus and accounts payable minus. So cash minus, okay, our guide, cash is an asset, cash minus is credit minus. And we have accounts payable minus, that is liability, accounts payable is liability, minus liability is debit liability. Okay? So, it means it is debit accounts payable and credit cash because it is minus cash, 8,800. Okay, next is May 29. We have cash minus and salaries expense plus. Okay, again, cash minus, cash is an asset, so minus asset is credit asset. And we have salaries expense, it is always plus, it is always debit. So we have 29, salaries expense, and credit cash. So debit salaries expense and credit cash, that is 21,000. Okay. We have 31. For 31, it is cash plus and delivery revenue plus. Cash is an asset. So, to increase our cash, that is debit cash. So, we have cash, debit, and we have delivery revenue plus. Again, in our guide, revenue is always plus. So, we have delivery revenue. for 39,000. Okay. Another 31. By the way, this is 30. So, 31, May 31, we have cash minus and gas and oil expense plus. Cash is an asset. To decrease our asset, it means we have to credit. And gas and oil is an expense. To increase it, it is debit. And expense is always debit. So we have gas and oil expense and credit cash of 12,500. Then we have another May 31 transaction. So for May 31 transaction, we have accounts receivable plus and delivery revenue plus. Accounts receivable is an asset. And to increase our asset, that is debit. And the other one, delivery revenue, in our guide, revenue is always plus. It is always credit. So we have accounts receivable and we have delivery revenue. That is 45,000. Okay, take note that this is the first transaction that I record in this page. That is why I have to write again the month. Okay? And the next one, we have another 31 transaction, cash minus and Aleph withdrawal plus. In our guide, cash is an asset. So, to decrease our asset, that is credit. And we have Aleph withdrawal, it is always plus. So, we have 31. This is the second transaction in this page. That is why I don't have to write again the month. It is only the date. So we have Aleph withdrawal. And we have credit cash. That is 14,500. So again, debit Aleph withdrawal and credit cash 14,500.